What massive difference is this going to make to consumers and to the economy? What can we expect to see?
Well, it's a really ambitious set of measures. The financial services sector affects us all in a couple of ways. First of all, it's the biggest, one of the biggest sectors, the things that the UK economy is good at. So we all depend on it to generate tax revenues. But obviously, it also affects all of our lives, getting our mortgages, how easy it is to get a credit, how costly insurance is. So the reforms that the Chancellor announced yesterday take advantage of some of our Brexit freedoms. A lot of the rules around financial services were increasingly made by Brussels. And a lot of them, because you have to get your 27 or 28 countries to agree, weren't the right fact pattern for us in the UK. We have different sorts of pension arrangements, for example. We save a lot into defined benefit or private pension schemes. In Europe, they tended to do something different. So when it came to setting those rules as to what pension schemes could do and invest, the UK got outvoted. So outside of the European Union, we've just been able to go back and look at the rule book again, put some more focus with the regulators, with big, powerful regulators in financial services. So one of the things the Chancellor's done is to ask them to have a lot more focus on growth, growing the economy, so we remain internationally competitive, and competitiveness, because we've got to compete with a big wide world out there. So I think they're a really good set of reforms. For those that have been saying, what are the benefits of Brexit? Point me to something. Then yesterday's package of reforms, a lot of them, not all, but a lot of them we could not have done if we were still in the European Union.
Andrew, some people might be a bit nervous about going down this route following the 2008 financial crash. Sir John Vickers, the economist who led the independent commission reviewing the banking industry after that 2008 crash, said that this could put the UK's financial stability at risk, and he was particularly concerned about plans to roll back ring-fencing rules, which George Osborne introduced to separate deposits from riskier investment banking. Are people right to be concerned in any way about these reforms?
No, the world's changed a lot, Philip, since 2008. The bank balance sheets weren't great then, but they're now much, much better. Some of the lending practices, you remember people were getting 125% mortgages. You can't do that now. That's been cracked down on. And there's a lot more transparency in the financial system. And to be clear, no one's ripping up the whole rule book. But what we're doing is looking sensibly again at some measures. So on ring fencing is still going to be there. But there's questions about if you're a smaller or a simpler bank, maybe not all of those rules apply to you. Maybe some of the bank's activities that maybe should never have been in the ring fence get relooked at, so they've got a bit more flexibility.
Andrew, our viewers will be thinking, thank goodness we're seeing Brexit dividends. Our viewers will be saying, that's what we wanted all along. That's why we voted for Brexit. Because at the moment, 65% are saying they think that Brexit is going badly. Only 21% say Brexit is going well. So they're looking to this to say, this is what we voted for. Can you promise that's going to be the case?
Yes, I can, because if you look at one of the biggest measures, Esther, was something called Solvency II. Now, I don't suggest at 10:20 on a Saturday morning we want to spend too much time talking about what it is. But what it means is that your UK pension fund money that was previously tied up in a very narrow range of investments can now be opened up. This is money for your long term, so you don't need access to it straight away. You want projects that will return a decent growth for you, so the money's there when you retire in 20 or 30 years' time. So projects you couldn't invest in before under the old rules, the old pre-Brexit rules, like a wind farm, clean energy projects, town centre regeneration, social housing, all of these projects that need a lot of private capital. Because as you said, the government spent a lot of money during COVID. So, we're not going to be able to do all of the regeneration of this country on the back of that.
Andrew, that's going to be music to our viewers' ears, because we said we've waited now several years and we're not seeing these dividends. So this, they'll be saying, thankfully, is the start of changes to come, Phil.
Yeah, Andrew, thank you very much indeed. I hope as well, just in passing, I hope you'll make sure that the regulator uses the freedoms that they've got from leaving the EU not to further increase regulation and actually to regulate more sensibly, because, of course, the danger is that you get the freedoms and the regulator just piles on even more regulation. So I hope you'll make sure that they don't do that.
We definitely don't want that. And, they've got a job to do and we want them to strike the right balance. But by having that explicit secondary objective about growth and about competitiveness, hopefully they'll apply that sensibly.
Brilliant. Andrew Griffith, Economic Secretary to the Treasury, thank you so much for joining us this morning.